Well, finance is a big part of our equation as value-add investors, right? You can't get to, mid to upper teens IRRs without good financing. We don't see a restriction in financing. We think it's starting to be driven more by the Pfandbrief market as an exit strategy for the lenders. And so Pfandbrief, the former, I can't remember the names anymore, Hypo Real Estate, right? The Good Bank, the Hypo Real Estate Good Bank is now the Pfandbrief Bank, and they've been quite active in the region. They typically top out at 50 to 55% LTV. So that's the one thing we've seen, is that means our real estate needs to be producing more income because we're taking lower leverage to still maintain our IRRs. Boy, even in far-off places, there's finance. I mean, I'll throw out UniCredit, who's I'll call it a friend of the firm and a big lender to some of our legacy funds. UniCredit claims they're active in every market, and that was a platform that had sort of been frozen for a little bit. So we're seeing definitely debt having turned the corner. It's an extremely important part of any investment. Just trying to imagine and think, were any of the transactions all equity in the last year? Maybe the L88 transaction in Prague. I don't know if they took that on the Radio Free Europe building.
They're buying equity, they're more likely to refinance post to a certain extent. But
So you got to have that, and I think it's not a problem if you have the relationships and you can prove you can manage the real estate.
So there's buying with, so people will go in, buy with equity, and then refinances afterwards, having got the better deal because they don't actually require the financing to make the purchase.
That's really only the German funds, the big German funds who are, to a certain extent, slightly awash with equity and capital at the moment, and hence they're the biggest buyers and the most aggressive at the moment. The main issue really is that I think most investors, or which many in the room here, you're now aware where your loan to values can be, you're aware of where the margins are. So you're realising, yes, there is more equity required, and that's been the case for the last few years. So there's no great shock of the bank suddenly being much more restrictive. The biggest thing after, obviously, asset and all the margins and loan to values is the relationship with that investor, with that borrower. The key investors who've got the key relationships with the main banks, the ones who are getting quite favourable terms. I was chatting with a guy last night who's now actually looking at zloty-based leases and is getting good financing and funding rates. Normally the banks have run a mile from he's looking small, let's call them tertiary retail, zloty-based leases with Biedronkas, Lidl's, smaller Tesco's, but he is getting good finance. And up to quite high, I was amazed at his loan to values, he's managed to get up to 65, even 70% on a couple of, but they are long-term leases, good covenants. But being zloty based, normally most banks will just shy away from that.
In general, I think the banks are just understanding real estate better and actually doing due diligence, which clearly a lot of them didn't do extensively in the past. So I don't think they're being more restrictive. They're just understanding what they're buying, and therefore some of the stuff, or what they're lending on, some of the stuff they were prepared to lend on in the past, clearly they're not prepared to today, but they probably shouldn't have been either in the past. So it's all about quality of location. The portfolio we sold to Heinz early 2012, when I would say financing was probably at its most difficult. It's all short-term leases, so the weighted average lease length was less than 3 years. And they still managed to go out and get it financed. In fact, they had 2 banks that were chasing it. So for the right quality and the right location, I don't think finance is an issue, unless you want to get yourself leveraged up above 60%, and then clearly you have a problem.